Good morning, sir.
Yeah, so today we are going to discuss a topic called capital gain tax. Capital gain tax. What do we understand by capital gain tax? We start from the introductions. So I've sent the material to the group chat. So capital gains tax started in 1967. So it started in 1967. It's an example of direct tax. So the simple definition of capital gain tax is a tax levied on gain arising from disposal of tangible assets. What we mean by that is that any gain arising from disposal of an asset, fixed asset, or capital asset, when you dispose it off, you make a gain from it. You are going to pay what is called capital gain tax. So when you make a gain from disposal of an asset, you are going to pay capital gain tax. So that is that. What that one means is that the difference between the cost of the sales proceed and the cost of acquisition is the capital gain. Why the tax is 10% of that capital gain is the capital gain tax. So we move to administration of capital gain tax. Who administer capital gain tax? We are talking about the tax authority that administer capital gain tax. Hello? The tax authority that administers capital gain tax. Who is the tax authority that administers capital gain tax? So that is what we want to look at now. For capital gain tax, it's been administered by both Federal Inland Revenue Service and State Board of Internal Revenue Service. If the seller of the asset, the person that sells the asset is a company or corporate organizations, so it's going to be administered by Federal Inland Revenue Service. But if the seller of the assets is an individual, it's going to be administered by State Board of Internal Revenue Service. So the administration of capital gain tax depends on the nature of transactions. The administration of capital gain tax depends on what? The nature of the transaction. Can you hear me, sir?
Yeah, we can hear you, sir.
Yeah. So that is that. The administration of capital gain tax depends on the nature of the transactions. So if the seller of the asset is an individual, it's going to be administered by the State Board of Internal Revenue Service. But if the seller of the assets, the person that makes the gain is a company or corporate organization, is going to be administered by State Federal Inland Revenue Service. So that is that. Now, the next thing that we need to look at now is basis of assessment for capital gain tax. What is the basis of assessment for capital gain tax? Capital gain tax is assessed to tax on actual year basis. Capital gain tax is assessed to tax on actual year basis. What that one means is that the capital gain tax runs from 1st of January to 31st of December. Capital gain tax runs from 1st of January to what? 31st of December. So it means it's on actual year basis. When you make a capital gain this year, 2024, you are going to pay the tax, the capital gain tax, on this year, 2024. You cannot pay it next year. That one means it's on AYB. Any gain you make in a current year, you are going to pay the tax in that current year. So that is that. Now, computation of capital gain tax. How do we compute capital gain tax? How do we compute capital gain tax? Based on this table, we compute capital gain tax using sales proceed, the amount that you sell the assets, less allowable expenses. Less what? Allowable expenses. Example of allowable expenses relating to sales. These allowable expenses, in some textbook, they call it selling expenses. In some textbook, they call it selling expenses. Example of that is sales commission, advertisement expenses. Sales commission, advertisement expenses, valuation fee. Any expenses that you incur in order to ensure that those assets that you want to sell can be sold, they are called allowable expenses or selling expenses. Do you understand? If you don't incur that expenses, you may not sell that asset. Do you understand? So they are called allowable expenses or selling expenses. When we minus it from the sales proceed, we get what is called net sales proceed. When we minus the allowable expenses, which is the selling expenses, from the sales proceed, we get what is called net sales proceed. After that, from the net sales proceed, we now less cost of acquisition. The cost that you purchase the assets at the time that you bought the asset is the cost of acquisition. Take, for instance, for building, cost of construction. Let me give a typical example. 5 years ago, you bought a motor vehicle. You bought it at the rate of 2 million naira. That was 5 years ago, 2017 or 2018. You bought it 2 million naira. You now want to sell it in 2024. Because of the foreign exchange rates, the price, despite that you have used it, maybe it's Toyota Corolla, the price has gone up. You now sell it 3.5 million naira. That 3.5 million naira is the sales proceed. The cost of acquisition is the 2 million naira. The difference between the sales proceed and the cost of acquisition is called capital gain. It's called what? Capital gain. And you are going to pay capital gains tax of 10% on it. Do we understand?
Yes, sir, we do.
Yes. So that is the typical example. And when you bought an asset too, at the time you bought an asset, fixed asset, there are some expenses that you incur, like take for instance, loading and offloading, clearing fee. You have to add it. All those expenses that you incur at the time of acquisition of that asset, when you are computing the capital gain tax too, you have to add it as part of cost of acquisition. Because we too in tax, we tax analysts too, we normally follow IAS, the IAS 16 that talk about capitalization of assets. That all the costs that you incur at the times of purchase of the assets to ensure that the asset is put into use, we need to do what? Capitalize it. So cost of acquisitions too, there are some incidental costs attached to it apart from the purchase cost. Apart from the purchase cost that you use to buy the asset, all those necessary incidental costs attached to the cost of acquisitions too must be added before you remove it from the net sales proceed. Do we understand? So that is that. The next line is allowable expenses and disallowable expenses. In relation to capital gain tax, there are some allowable expenses, there are some disallowable expenses. Like I show you the format, under the sales proceed, we minus allowable expenses. What are those expenses that is allowed that we can minus from the sales proceed for us to get the net sales proceed? Example of them is the cost of acquisitions, which is the purchase cost, is allowable. Improvement costs, any cost that you incur on the asset to improve the life of the asset is allowable. So you are going to remove it. When you are computing your capital gain tax, you are going to remove it from the sales proceed. Cost of preserving or defending the owner titles over the right, the owner title to a right over the assets too is allowable. Incidental cost of disposal. At the time of disposal of the asset, some costs that you need to incur, like advertisement costs, legal fees, auctioneer fees, stamp duties, valuation fees. All these costs, they are allowable. So as a good student, you need to know at least 5 allowable expenses in relation to capital gain tax. 5 allowable expenses in relation to capital gain tax. So it's in our pack here, our study material. I've mentioned them one by one. Secondly, disallowable expenses. Disallowable expenses. Disallowable expenses. What are those expenses? That if you incur it, you cannot minus those expenses from the sales proceed when you are computing your capital gain tax. Number one, sum of allowable expenses, sum of allowable as a deduction in computation of profit or gain for income tax purpose. What this one means is that all the allowable expenses under company income tax or personal income tax, do you understand? They are disallowable under capital gain tax. Example, telephone and postage, printing and stationery, traveling and transport. They are allowable expenses under company income tax. They are disallowable under capital gain tax. Since you are going to use them as a company when you are computing your company income tax, or as an individual when you are computing your personal income tax, you are going to use them as an allowable expenses for you to arrive at your adjusted profit. So you cannot come and deduct them from capital gain tax again. You cannot come and deduct them from the net, from the sales proceed again. Like this place now, sales proceed, less allowable expenses. The only allowable expenses that you can deduct is the one I mentioned, which is 2.5.1. Any other allowable expenses like transport and traveling, printing and stationery, telephone and postage, donation, you cannot come and use them under capital gain tax. They are applicable under company income tax and personal income tax. So under capital gain tax, they are automatic disallowed because you have used them under company income tax already. You cannot come and use them again under capital gain tax. Do we understand? Do we understand?
So help us
Yes, sir.
to this, sir.
So that is that. Second expenses, disallowable expenses under capital gain tax. Insurance premium on assets. When you bought an asset, you now pay insurance premium on it. You now sell the asset. That insurance premium that you pay, you cannot come and use it as an allowable expenses or to come and remove it from your sales proceed to get your net sales proceed. Insurance premium is not allowed for deduction. When you take, for instance, now, you have a building, you bought a building, you now insure that building. You bought the building 20 million naira, you now insure it 1 million naira. At the time you want to sell the building, you now sell it 30 million naira. For you to compute the capital gain tax, 30 million naira minus 20 million naira, you will not use that 1 million naira insurance premium. It's not allowed under capital gain tax. You understand? Assuming that insurance premium now is assuming it's an advertisement cost now, you can say, okay, cost of acquisition plus allowable expenses or incidental costs. You add the two of them together, you minus it from the sales proceed to get your capital gain tax. Another example of disallowable expenses under capital gain tax, higher purchase interest. Higher purchase what? Interest. When you buy an asset through higher purchase, you buy an asset through what? Higher purchase. You know, when you buy an asset through higher purchase, the higher purchase price will be different from the cash price. The difference between the higher purchase price and the cash price is the interest element. Now, I bought a motor vehicle through higher purchase. The motor vehicle, I bought it through higher purchase 3.5 million naira. If I want to buy it by cash, if I want to buy it by cash, I will pay 3 million naira. But because I want to pay on instrumental, the seller said I will pay 3.5 million naira. At the time I now sell the motor vehicle, I now said after using it for a while, I now sell it. I sell it 4 million naira. If I want to compute capital gain tax, I will say 4 million naira is the sales proceed. The cost of acquisition will be only the cash price alone. Only the cash price alone. I will not recognize interest. In that case, 4 million naira minus 3 million naira, I will get my capital gain and I will compute 10% interest of 10% tax of capital gain tax. That interest element, I will not recognize it as part of cost of acquisition. It's the cash price I will recognize by the time I want to sell the assets. Let me repeat myself again. I bought an asset, a motor vehicle. I bought it 3.5 million naira through higher purchase. 3.5 million naira through higher purchase. I bought the motor vehicle 3.5 million naira through higher purchase. The cash price of that motor vehicle is 3 million naira. It means the interest element on that transaction is what? 500,000 naira. So 3 years after, I now sell the motor vehicle. I sell it at the rate of 4 million naira. If I want to compute capital gain tax, 4 million naira minus 3 million naira. That is 1 million naira is the capital gain. 10% of that 1 million naira is the capital gain tax. I will not recognize the interest elements. So that is the number 3 that said higher purchase interest, where the chargeable asset was acquired on higher purchase. Now, 2.6 rate of capital gain tax. What is the rate that we use to compute capital gain tax? Presently, the rate of capital gain tax is 10%. 10%. Before, the rate of capital gain tax was 20%. That was 1995, up to 1995. But as from 1996 up to date, the rate of capital gain tax still remains 10%. The rate of capital gain tax still remains 10%. Do we understand? Now, 2.7, capital gain tax return and penalty for late filing. Capital gain tax return and penalty for late filing. What is the timeline for filing capital gain tax return? The law said that as a company or as an individual, you must file capital gain tax return twice in a year. You must file what? Capital gain tax return twice in a year. First, as at 30th of June, you will file capital gain tax return for capital gain tax transaction that arises from 1st of January up to 30th of June. Your own return must be filed 30th of June. What we mean by that is when you sell an asset, you sell an asset in the month of April. The deadline of filing the return for that asset that you sell in the month of April is 30th of June. When you sell an asset in the month of January, the deadline of filing return for that asset you sell in the month of January is 30th of what? June. When you sell an asset in the month of July, the deadline of filing return in respect of that asset is 31st of December. When you sell an asset in the month of October, the deadline of filing return in respect of that asset is 31st of December. Failure to file return, what is the penalty? When you fail to file capital gain tax return, you are going to pay penalties of 10% plus interest at prevailing commercial rates. Interest fixed by CBN. When you fail to file return in respect of capital gain tax within the due date, which is 30th of June, 31st of December, if you don't file return as at that date as a company or as an individual, you are going to pay a penalties of 10% of the amount of capital gain tax due, plus interest at the ruling commercial rate. That interest at the ruling commercial rate is the interest determined by the CBN. Do we understand? Do we understand, class?
No, sir. No, sir. So can you explain more on the interest on the ruling commercial rate? Maybe with an example.
Example. Interest on ruling commercial rate means the minimum lending rate fixed by CBN. Every month, CBN normally fix a rate. They call it monetary policy rate. That if a bank want to give a loan out to customer, this is the minimum rate they must charge you. So that monetary policy rate normally change from time to time. So if you want to compute penalty for not filing capital gain tax return, apart from using 10% of the amount due, we are also going to use, sometimes that monetary policy rate can be 21%. We are also going to use 21%, apart from using 10%. Because this 21% is fixed by CBN. The idea is that government assume that you have used their money, because that capital gain tax is government money. You have used it to do business, and you are going to pay interest on it. You have used it to do what? Business, and you are going to pay interest on it. So that is the reason why they said interest at prevailing commercial rates. Interest at prevailing commercial rates. Anytime you are computing penalty for any tax, we normally use CBN interest too, apart from interest fixed by the law. This 10% is fixed by capital gain tax law. The interest at prevailing commercial rate, that one is fixed by CBN. Now, 2.8. 2.8. Assets or gain subjected to capital gain tax. Assets or gain subjected to capital gain tax. What are the assets or gain that are subjected to capital gain tax in Nigeria? This area is very important. In most of our examinable questions, in most of the past questions, you can be asked, list or explain 5 assets subjected to capital gain tax. Do you understand? So most of our questions for advanced tax, 60% of it can be on theory, while 40% will be on calculation. In some diets, the question will be 50% theory, 50% calculations. So we should focus more too on theoretical aspects. Do we understand? Do we understand?
Yes, sir.
Yeah, we
Yes,
see,
sir.
sir. Thank you.
So what are the assets subjected to capital gain tax? According to Section 3 of Capital Gain Tax Act, the following assets are subjected to capital gain tax. Number 1, incorporeal properties. Example of incorporeal properties, they are fictitious assets. They are intangible assets, e.g., goodwill, copyright, trademark, patent rights. When your company has a goodwill, they now sell that goodwill, they will pay capital gain tax on it. When you have a trademark or you have a patent right, you now sell it out, you will pay capital gain tax on it. So incorporeal property means fictitious asset, intangible assets. They mean they are the asset, they are assets that arises as a result of legal rights. When you have a legal right on something. So when you sell the rights, you are going to pay capital gain tax. When you sell the rights, you are going to pay capital gain tax. So that is number one asset. Number two assets, options. Options. Options means you are a retailer and no seller, or you are no seller. Manufacturer give you an option to come and buy a product at a discount rate. At a discount rate. Take for instance, you are into a downstream petroleum company. You have a filling station. So the petroleum distributor, the marketer of petroleum, the petroleum marketer, they now give you an option that, AYZ filling station, we are going to supply you 10 loads, 10 tank of PMS at a discount rate. 10 tank of PMS, we are going to supply you as a discount rate. That is an option. But you as a filling station, you don't have capital, you don't have money to exercise that option. You don't have money to exercise that option. You may decide to sell it to another filling station. Assuming they say that one tank of PMSO, they are going to sell it for you at the rate of 5 million naira. And they give you an option that you have an option to buy 10 tanks. And you don't have money. Or you have money, your money is not enough. You have money to just buy only 5. It remains 5. That 5 remaining, you may decide to sell it to another filling station and you make a gain. By adding money to it, you go and approach another filling station. I've been given an option to come and buy a tank of PMS at a discount rate. They said I should come and buy it at the rate of 5 million naira. And you know that if you want to go and buy it from them now, they will sell it for you at the rate of 7 million naira or 6 million naira. So you know what I will do? I will sell this option for you. I will sell 5 out of the 10 for you. And you will now buy it at the rate of 5.5 million naira. It means you have made a gain of 500,000 on each of the tanks. That 500,000 that you make a gain from it is a capital gain, and you will pay capital gain tax on it. That is an option. When an wholesaler or retailer is given an option, and because of fund, he cannot exercise the option, he now transfer it to another party. By transferring it to another party, when the other party exercises the option, that old person have made a gain and is going to pay capital gain tax. Number this, debt. 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 Debt simply means somebody is owing you money. And the person promised, the debtor promised that he's going to pay back within 90 days. And you cannot wait for 90 days. You need money. You need cash. You can't wait for 90 days. You can go and approach debt factorization or debt factoring. You can go and involve in debt factoring by meeting some company. They will buy off the debt from you. Assuming somebody is owing you 300 million naira and you need money to finance your working capital. The person said he's going to pay within 90 days. You cannot wait for 90 days. You can go and approach some company. Their own job is to factorize the debt. You go and approach them. Somebody is owing me 300 million naira. He's promising me to pay within 90 days, but I cannot wait for the 90 days because I need money to run my business. Come and buy this debt. So the debt factoring company, they will buy it. They will not pay you 300 million naira. Rather, they will pay you lesser amount. They may pay you like 290 million naira. Because they want to buy it at a discount. They will pay you 290 million naira. Give you a cash of 290 million naira since you cannot wait for 90 days. When the 90 days now reach, the debt factoring company will now approach the debtor. They will now collect the 300 million naira. What that one means is that the debt factoring company have made a gain of 10 million naira. They have made a gain of how much? 10 million naira. The difference between 300 million naira and 290 million naira that they pay the creditor, they have made a gain of 10 million naira. That gain of 10 million naira that they make, they will pay capital gain tax on it. So that is debt. Another asset subject to capital gain tax is any currency other than Nigeria currency. Any currency other than Nigeria currency. When you trade, when you sell foreign currency, you buy $1. At the time you buy $1, you buy it at the rate of 1,000 naira for $1. You now buy $500, and each one costs 1,000 naira at the time you buy it. When you want to sell it, you now want to sell the dollar. The rate of exchange has gone up. You now sell it at the rate of $1. You sell it at the rate of 1,200. You have made a gain of selling foreign currency. You have made a gain of selling foreign currency. So by virtue of that, you need to pay capital gain tax. By virtue of that, you need to pay what? Capital gain tax. Another example of assets subjected to capital gain tax.
Sorry, sir.
Any form of property.
Hello, sir. Sorry, sir. I had a question.
Yeah. Okay.
Okay. In the case of any currency than Nigeria currency,
yeah,
where they trade dollar to naira and all of that. So most of these abokis, sorry, I use that word. Most of these guys on the streets that I don't think their business is even registered. So how did the government trace them to ensure that they comply to these rule and regulations, or to get their capital gain tax from them? Because most of the times you can see them on the streets doing their business and all of that.
Now, the problem now is for Bureau de Change company, their own primary business is to transact exchange rates. Do you understand? Such kind of people, they are not expected to pay capital gain tax when they make gain from foreign currency, because there is their primary business. Rather, at the end of the day, they will pay company income tax from the profit that they make, or pay personal income tax, because that is their primary business. They are registered under CBN. Do you understand? But those people, the kind of people that we are referring to somebody that is not in business of Bureau de Change, that is not in business of a foreign exchange transaction, that is not registered under CBN, that just buy it and sell it, is not recognized as his own business. Those are the people we are referring to. Those are bookies. They are registered under CBN. So we can't expect them to be paying capital gain tax for any gain that they make, because it will serve as a multiple tax for them. Because in the long run, they will still pay personal income tax or pay capital gain, company income tax for any profit that they make from foreign exchange transactions. Do we understand? Have I answered your question now?
Yes, sir. Yes, sir.
Okay.
So please,
So
I have a
another
question,
form of,
please.
yes,
Hello, sir.
yeah, I
Please, I
can
would
hear
want
you.
to know, when a loss is made on disposal, is it carried forward to next year, or how is it treated? You didn't tell us.
I'm still coming to that. I'm
Okay,
still
sir.
coming to that. Finance Act 2023 said when you make a capital loss, you are allowed to carry it forward for maximum of 3 years. When you make what? Capital loss. Capital loss means the cost of acquisition is greater than what? The sales proceed. The cost of acquisition is greater than what? The sales proceed. In that case, it's no more capital gain. It's a capital loss. You are allowed to carry it forward for maximum of 3 years. This was introduced by Finance Act 2023. It means carrying forward of capital loss started last year. So when you have a question that relates to carry forward capital loss, it depends on the year given to you. If the year end given to you ends in 31st of December 2023, you are allowed to carry it forward. But if the year end is 2022, 2021, you don't allow to carry it forward. Because Finance Act 2023 cannot applicable to year end 2021, year end 2022. You need to be careful. Do we understand? Do we understand?
Yes, sir.
Okay.
Yes, sir, we do.
So, another asset, any form of property created by person, disposing of it, or otherwise coming to be owning it without being acquired. So you pay capital gain tax on it. Another asset that you can pay capital gain tax on it, stock and shares. When you buy stock and shares and you now sell the stock and shares, effective from 1998, you will pay capital gain tax on it. Prior to 1998, when you sell stock, you sell share, you make a gain from selling of share, you don't pay capital gain tax. But as from 1998, anytime you make a gain from selling of shares, you pay capital gain tax. Another example of assets subjected to capital gain tax is all qualifying capital expenditure. All qualifying capital expenditure, such as plant and machinery, furniture and fitting, motor vehicle, office equipment, land and buildings. All the capital expenditure that you can put capital allowance on, you pay capital gain tax on them. Do we understand? So that is that. Asset exempted from capital gain tax. What are those assets? When you make a gain from them, you will not pay capital gain tax. Number one, gain from disposal of Nigeria government security. When you subscribe for Nigeria government security, example of government security, Treasury bill, Treasury certificates, development bonds. All these, they are government securities. When you subscribe for it, you bought government security. Maybe you bought bonds, you purchase a bond. At the time you purchase it, you bought it at the rate of 2 million naira. Before the maturity of the bond, you now want to sell it. You now sell it at the rate of 3 million naira. You have made a capital gain of 1 million naira. The law said you will not pay capital gain tax, despite making a gain. So gain from disposal of government security is exempted from capital gain tax. Another example of assets exempted from capital gain tax. Gain from disposal of mechanically propelled vehicle used as private vehicle. When you are using a private, when you have a private vehicle, your private car, your private car, not official car, you now dispose it off, you make a gain from it. You will not pay capital gain tax. Gain accrued to local or native authority. This one, in some textbooks, they will say gain accrued to local government authority. Gain accrued to local government authority. Gain accrued to local government authority. Anytime local government sell an asset, they make a gain, any form of asset. When they make a gain, they will not pay capital gain tax because they are governments. They are governments. They will not pay capital gain tax. Another one, gain accrued to charitable or educational institutions. When a company is registered by Guarantee, such kind of company like NGO, non-governmental organization, charitable organization, orphanage home, all these kind of people, when they sell an asset, they make a gain. The law said they will not pay capital gain tax. Another one, any capital gain on disposal of life assurance policy. You dispose your life assurance policy before it matures. You now make a gain from the disposal. You will not pay capital gain tax. Another one, any gain, any capital gain from disposal of medal or decoration won for honor or for valor or gallantry efforts. What this one means is that you are a member of Olympic. You represent Nigeria through Olympic. You now won a gold medal in Olympic. When you want to dispose that gold medal that you won in Olympic, you will not pay capital gain tax. Or you are given an honor. President give you an honor. OFR, CFR, MFR. That honor, that decoration given to you, you want to sell it, you will not pay capital gain tax. You will not pay capital gain tax. You will not pay capital gain tax. So those are the assets that are exempted from capital gain tax. Another asset exempted from capital gain tax from Finance Act 2021 said when you receive a compensation for loss of office and that compensation for loss of office does not exceed 10 million naira, you receive a compensation for loss of office. That compensation for loss of office does not exceed 10 million naira. you will not pay capital gain tax. But if the compensation for loss of office, somebody was asked that, okay, they are doing reorganization in your company, please, your department is no longer needed. At the end of the day, they now pay you an exit package. If the exit package is less than 10 million naira, you will not pay capital gain tax. But if the exit package is more than 10 million naira, you will pay capital gain tax on it. Another assets that are exempted from capital gain tax are any capital gain accrued to diplomats, foreign diplomats. Foreign diplomat means all those embassies, foreign embassies that we have in Nigeria. All those foreign embassies that we have in Nigeria. UK embassy, America embassy, German embassy, they are corporate organization on their own. Anytime that they dispose an asset, when they make a gain, those assets will not be subjected to capital gain tax. Another asset that will not be subjected to capital gain tax that we also have here is gain arising from disposal of land or disposal of building acquired by government through false acquisition. Government acquire your land or they acquire building through false acquisition. The owner of the land don't have intention of selling the land. They don't have intention of selling the building. But government acquire it through false acquisition. How can that happen? Government want to construct a road. They want to expand the road expansion. They now look at that, most of this area, we need to demolish some of the houses for us to construct some bridge or for us to expand the road. They now approach the owner of the building, the owner of the land. They now write a letter to them that as a result of construction of road, your house has to be demolished. Government has to pay them compensation. They have to pay them compensation. That compensation paid to them by government is gain. But that gain is as a result of false acquisition. They will not pay capital gain tax on it. Because somebody that acquired a land 20 years ago, he may acquire the land 500,000. 20 years down, government now want to use the land. They will now want to use the land for road expansion. Compensation that the government will pay you will be more than the cost that you acquire the land, provided that you have a C of O. Will be more than that. So you have made a gain, but that gain will not subjected to capital gain tax because it's a false acquisition. Another asset that is exempted from capital gain tax, compensation received for injury or damage suffered. Somebody is working in a factory. As a result of his nature of work, one of his hands, due to some of the factory equipment, one of his hands have to be damaged, or his leg was damaged. They now pay him a compensation, heavy compensation. That heavy compensation that they pay him because of that injury, it will not be subjected to capital gain tax. Another asset exempted from capital gain tax, gain arising from disposal of shares through merger and acquisition or absorption. Two companies merge together. One company absorb another, acquire another, take over another company. As a result of that, one have to dispose his shares. Do you understand? Any disposal of share arising from merger, acquisition, absorption, takeover between two companies, when there is a gain from disposal of that share, that gain will not be subjected to capital gain tax. So I've listed so many assets exempted from capital gain tax. So as a good student, we're expected to know at least 10 assets exempted from capital gain tax. At least 10 assets exempted from what? Capital gain tax. So that is that. The next line that we are moving to now is connected party transaction.
Sorry, Mr. Idris.
Yes, sir.
Yeah, good morning, everybody. So I just want to reiterate that we should not forget that the assets during the acquisition and merger, when it is disposed, even though it is exempted from capital gains tax, Mr. Idris has put here that provided the asset is not disposed again within 365 days, that is the only situation where the asset will be exempted from capital gains tax. If peradventure either of the party dispose the asset, such will not be exempted from capital gains tax. I just want to put that as an addition.
Okay, thank you very much, sir. Yeah. So connected party transaction. Connected party transaction. 2.9. Who is a connected person? Connected persons are the category of individual that are related, category of individual or company that are what? Related. They are related. As a result of that, transaction between connected persons in relation to Capital Gain Tax Act is referred as artificial transaction. Transaction between connected persons in relation to Capital Gain Tax Act is referred as what? Artificial transaction. Artificial transaction means transaction that is not done at arm's length. Transaction that is not done at arm's length. So they are the transaction between connected persons. Connected persons simply means individuals or companies, two or more individuals or companies that are related to each other. They are closely related to each other. So transaction between them will be regarded as what? Artificial transaction. It means transaction between them is not done as arm's length. What we mean by connected person in this capital gain taxes, when two parties, buyer and seller, the owner of the asset, the seller of the asset, and the buyer, they are connected persons. I sell an asset, I sell a motor vehicle to my wife. My wife is closely related to me. The law is now saying that transaction is an arm's length. It's an artificial transaction because my wife is related to me. So the sales price I'm using to sell the asset, to sell the motor vehicle to my wife is artificial. In that case, the law is going to determine what is the market value of that asset. What is the market value of the motor vehicle? Take for instance now, I sell a motor vehicle to my wife, one of my car, and now said, my wife, I want to sell it to you. That transaction is a connected person transaction. It's a connected party transaction. My wife is related to me through marriage. I sell it 2.5 million naira. That is the sales proceed. That selling price I sell it is an artificial transaction It's not done as arm's length. Tax authority will now say, okay, that asset, that motor vehicle that you sell to your wife, how much they are selling it in the market? What is the market price? If the market price is more than the price that I sell it, by the time they want to compute the capital gain tax, they will use the market price. They will use the market value. Assuming I sell it to my wife, 2.5 million naira, they now discover that the market price is 3.5 million naira. If they want to compute capital gain tax on that motor vehicle, instead of saying 2.5 million naira is the sales proceeds, they will use 3.5 million naira because the market price is greater than the amount I sell it. Do you understand? But if the market price is less than the amount I sell it to my wife, they will use the amount, the price, the selling price I used to sell it to my wife. They will not use the market value. So what that one means is that in a connected person transaction, the consideration, the sales consideration will be the higher of selling price or market value. The higher of what? Selling price or market value. Example of connected pricing transaction. An individual is connected to his or her spouse, meaning that husband is connected to his wife. Wife is connected to her husband. That is number one example. A trustee is connected to a settlor in a settlement transaction. That is number two example of connected person transaction. Number three, a partner is connected to other partners. A partner is connected to other partners. Partners in a partnership business. Number four, a company is connected to other company, either by subsidiary or by associates or by joint venture. So these are the example of connected persons transactions. These are the example of connected persons transaction. So what the law requires us to know in a connected person transaction is that anytime that there is a transaction between two connected persons, the consideration, the sales consideration will be the higher of the sales price and the market value. So that is connected persons transaction. Now, 2.10. Partial disposal of an asset. Partial disposal of an asset. Partial disposal of an asset. What we mean by that is when part of the asset is disposed, while some part is not disposed. Part of the asset is disposed, while some part is not disposed. It's called partial disposal of the asset. Take, for instance, you have a building. That building have 4 blocks of flats. You now dispose 2 blocks of flats from that building. It remains 2 blocks. That is partial disposal of an asset. Now, the problem now is that at the time that you acquire that building, because of the acquisition is for 4 blocks of flats. When you want to dispose, you now dispose 2. You not dispose 2. The question now is that How do you determine the cost of the part that was disposed? How do we determine the cost of the part that was disposed? How do we determine the cost of the part that was disposed? Because you know the amount, the price, the selling price of the part that was disposed. For you to compute the capital gain tax, you need to know the cost of acquisition of the part that was disposed too, so that you can get your capital gain and you compute your capital gain tax. Now, for you to determine the cost of the part that was disposed, there is a formula called A all over A plus B times C. A all over A plus B times C. A stands for sales proceeds or consideration received for the part that was sold. While B stands for market value of the part that was not sold. Market value of the part that was not sold. While C stands for cost of acquiring the asset. At the time you bought the asset, the cost that you used to acquire them. So A all over A plus B times C. You use it to get the part that was disposed. The cost of that part that was disposed. So when we are doing an illustration, we will look at it extensively. When we are doing an illustration, we will look at it extensively. Two point 2.11, capital gain tax and hire purchase transaction. Capital gain tax and hire purchase transaction. Capital gain tax and hire purchase transaction. What we mean by this is that when you acquired an asset through hire purchase, you acquire an asset through hire purchase. Do you understand? You acquire an asset through hire purchase. And after using the asset for a while, you now want to sell the asset. You now want to sell the asset. How do we compute the capital gain tax? How do we compute the capital gain tax? What the law is saying now is that I acquire an asset through hire purchase. How much they are selling it cash price? Assuming if I want to acquire that asset, cash price is 2 million naira. And they say if I want to acquire through hire purchase, so that I will pay in instrumental for some number of years, is 3 million naira. And I acquire it through hire purchase. At the time I want to sell that asset, if I want to compute the capital gain, it's going to be the sales price, sales proceeds, less the cash price. I will not include the interest element, because the difference between the cash price and hire purchase price is the interest element. The difference between the cash price and the hire purchase price is the interest element. So I will not include the interest element. Cost of asset acquired through hire purchase. Under this hire purchase, we are going to look at it in two angles. We are going to look at it in two angles. When you dispose an asset acquired through hire purchase, after you have paid all the installments, installments have been paid fully. Another angle, after you have not paid the installment fully, you have not paid all the installment finished before you dispose the assets. The first angle is, how do we compute the capital gain tax liability for an asset that you acquire through hire purchase and you are still paying the installment? You have not fully paid the installment finish. What that one means is that the new buyer of the asset is the one that will pay the installment finish. In this first instance, installment has not been fully paid before disposal is made. When installment has not been fully paid before disposal is made, you that you want to sell the asset, you the old buyer, that you want to sell the asset to the new buyer. The new buyer is the one that is going to complete the installment payment. The price that you are going to sell the asset will be less. And if we want to compute the capital gain tax, the sales proceeds less deposits, initial deposits. We minus initial deposit you have made from the assets. And we also minus the installment you have paid so far from the asset. That installment you have paid so far, only the cash installment. We will have removed the interest from the installment. We will not add the interest from the installment. We will have removed it from the installment. Only the cash aspect of the installment is what we are going to minus. Let me explain again. First scenario. You buy an asset through hire purchase and you want to pay for installment for 5 years. After 3 years, you are no longer interested in the asset. You have not finished paying the installment because you are going to pay the installment for 5 years. 3 years, at the end of 3 years, you now say, let me sell the asset. What that one means is that you have paid 3 installments, it remains 2 installments. When you sell the asset that time, the 2 installments remaining is the new buyer that will go and pay it complete. You that sell the assets, you have paid 3 installments. For us to compute the capital gain tax, the sales proceeds that you sell the assets, less initial deposit at the time you buy the asset, and you also less the 3 installments you have paid on the assets for you to get the capital gain. When you get your capital gain, you compute your capital gain tax. And the installment, that 3 installment we are lessing, only the cash elements we are lessing. We will not less the full installment because the installment you are paying every year, it comprises of cash and interest. You have to remove the interest part. You have to remove the interest part. It's only the cash aspect that you are going to pay. It's only the cash aspect you are going to pay. That is when the assets, when the installment of the asset have not been fully paid. But Second scenario, when the installment on the assets have been fully paid. What this one means is that you have paid for the asset finish. You have paid for the asset. You have paid it finish. So for you to determine your capital gain tax, sales price that you sell the asset, since you have paid the asset finish, you have paid the installment on the asset finish, sales proceeds less cash price. The cash price, how much you will have buy the asset when you pay by cash. Do we understand? Do we understand? Do we understand?
Yes, sir.
Okay. So that is that. Let's look at one illustration relating to hire purchase. Let's look at an illustration relating to hire purchase. Union Company Limited purchased a chargeable asset on hire purchase. The deposit paid for the purchase was 250,000. The balance of the purchase price was to be paid in 36 installments, in 36-month installments of 25,000 monthly. The cash price of the assets is 790,000. Calculate the capital gain tax due, assuming the asset was sold as follows. Calculate the capital gain tax due, assuming the assets were sold as follows. A, the asset was sold for 1,250,000, 1,250,000 naira after payment of 24 installments. B, the asset was sold for 1.3 million naira after full payment of all the installments. Now, how do we compute the capital gain tax when they pay 24 installments? The full installment payment is 36 months, but they sell the asset, a scenario now. They sell the asset when they have paid for 24 months installments. They sell the assets when they have paid for 24 months installment. Sales price is 1.2 million, 1.250 million, 1,250,000. We will now less cost of acquisition. Our cost of acquisition in this scenario will be 250,000 naira, which is the initial deposit. Also, the installment, how many installment was paid? 24 installments. 24 times every month installment is 25,000. 24 times 25,000 naira, we get 600,000. That is the installment. This installment of 600,000 naira, it includes interest elements. It includes what? Interest elements. We now minus the interest elements. Every month, how do we get the interest element every month? How do we get the interest element every month? What we can do for us to get the interest element every month, we know that the cash price of the asset is 790. For us to get the highest purchase price, the initial deposit is 250. and they are going to pay for 36 months, 25,000 every month. Do you understand? So for us to get the interest element, 36 times 25,000, we get the total installment. We add it with the total installments. We add it with the initial deposit. We get the total higher purchase price. We now minus the total higher purchase price from the cash price. We minus the total higher purchase price from the cash price. We get the total interest. Let me share an Excel how we can compute the interest element on this transaction. Let me share an Excel on how we can compute the interest element. So, deposit that they paid, 250. The total installment that they will pay for the 36 months, 900,000. The total higher purchase price, total HP, higher purchase price is going to be 250 plus 900,000. So it means the total higher purchase price is what? 1,150,000. And if they want to buy it, cash price, the cash price, how much is the cash price? Cash price. We know how much is the cash price. Cash price is 790,000. So the interest.
Hello, sir.
Is,
Please, we can't
yes,
see what you're doing.
sir?
We can't see what you are solving, sir.
I will show you clearly. I'm coming.
Okay.
Interest, total interest. I will show you clearly. Let me just finish. Can you see it very well now? Hello, class?
No, sir.
Can you
No,
see
sir.
it?
No, sir.
I've shared it. Can you see it?
Not yet, sir. Can't
It
see
has
it.
not appeared yet.
Huh?
It has not appeared here yet. Probably later on.
Okay, let me share it again. Can you see it now?
Yes, you can.
So what I'm saying now is, for me to get the interest element, the deposit, 250,000. The installment for the 36 months is how much? 900,000. Can you see that?
Yes, sir.
The total higher purchase price they are going to pay is how much? 1,150,000. We minus cash price, and we know that the cash price is what? 790,000, Abi? 790,000, Abi? Hello?
Yes, sir. Yes, sir.
Yes, you get the total interest. Do you understand?
Yeah.
Now, your monthly interest monthly interest. Monthly interest is going to be this total interest, 360, divided by how many months? 36 months. You understand? It means every month from the 25,000 installment is paying, every month, the interest element from the 25,000 is how much? 10,000 naira.
10,000.
Do you understand?
Yes, sir.
So if we go back to our workings,
Yes.
So for the first one, after 24 month installments, we said after 24 months installment, Abi. So look at the solution. Deposits 250,000. Installment paid 24 times 25,000. That is the installment. We now minus interest element from it. Interest element for 24 months. 10,000 times 24 months. We minus it, Abi. When we minus it from the installment of the 24 months, we get 360,000. Can we see that? Eh? Can we see it? Hello,
Yes, sir, we
class?
can. Yes, we can.
So now 250,000 naira plus 360, we are going to get 610,000. That is the total cost of acquisition. We minus it from the sales price. When we minus 610,000 from 1,250,000, we get 640,000. That is the capital gain. Do we understand? So 10% of it is going to be what? Capital gain tax. 10% of it is what? Capital gain tax. So that is for 24 month installments. That is for what? 24 month installments. For the one of 36 month installments, B part of it, they said, he said the asset for 1.3 million naira after full payment of all the installments. The full payment of all the installments is 36 months, Abi. The full payment of all the installments is what? 36 months. Now, 1.3 million naira initial deposit. The installment is going to pay for the 36 months. Interest elements. Interest element. We minus it for the 36 months. We get 540,000 naira. From the 540,000 naira, we add it with the 250,000. We get 790,000. That is the total cost of acquisition. For us to get the capital gain now, sales price minus the total cost of acquisition, which is 1.3 million naira minus 790,000. We get what? 510, which is the capital gain. And we compute 10% of it, called capital gain tax, which is 51,000. So, do you have any question on this? Do you have any question on this? Hello, class? Do you have any question on this? Okay, in case of no question, can we proceed? Can we proceed? So we can proceed. (2.12) Loss on disposal of tangible assets. This one is talking about capital loss, like I explained before. Capital loss. Finance Act 2023 said, anytime that there is a capital loss, you can relieve the capital loss against future capital gain. You can relieve the capital loss against what? Future capital gain. You can relieve the capital loss against future capital gain. When you sell an asset, you make a capital loss. What that one means is that the cost of acquisition is greater than sales proceeds. Do you understand? You make a loss. So when you make that loss, you can relieve the loss against any future capital gain of the same assets, of the same chargeable assets. Let me give example. I sell a land and build. I sell a building. Initially, I bought the building for 15 million naira. When I'm now selling the building, I now sell it for 12 million naira. Selling price is 12 million naira. The cost of acquisition is 15 million naira. Indirectly, I've made a capital loss of 3 million naira. In future, if I buy another building, if I now sell the building, I now make a gain. In future, if I buy another building, I now buy another building, I now make a gain. Assuming I make a gain, I make a capital gain of 5 million naira. Before I can pay capital gain tax on that 5 million naira, I will remove 3 million naira capital loss I've suffered in the old building that I've sold. In the old building that I sold in the previous year. Do we understand? Do we understand?
Yes, sir.
I will remove it. I will remove it. So, this was introduced by Finance Act 2023. He said, when there is a capital loss, you can carry the capital loss forward for maximum of 5 years, not 3 years. I mentioned 3 years initially. Is maximum of how many years? 5 years. That capital loss, if you carry it forward for maximum of 5 years, and you didn't make a capital gain from the same asset for that 5 years, after the 5 years, that capital loss is automatically lost. You cannot claim it again. Let me give the example again. Let me give example again. Let me give example. Let's use an Excel to give example. Let me use an Excel to give example. Let me use an Excel to give example. Look at it. In year 2021, 2023 year of assessment. Year of assessment 2023. A building I sell a building. I sell it. Sales proceed. Sales proceeds of that building I sell is 13 million naira, for example. ₦13 million. For that building. When I acquire that building, cost of acquisition, cost of acquisition of that building was 15 million naira. Cost of acquisition is 15 million naira. Now, there is a capital loss. There is a capital loss of how much?
A capital gain, sir.
Huh?
Okay, 2 million.
2 million. Can you see it?
Yes, I can.
You can see that there is a capital loss. The law says this capital loss, I can carry it forward for maximum of how many years? 5 years. Now, this 13 million naira in year 2024, I now use it to purchase another building. I now use this 13 million naira to purchase what? Another what? Another building. So the cost of acquisition of that building, part of this 13 million naira, I use it to buy another building. The cost of acquisition of that building is what? 12 million naira. $12 million. That is the cost I used to acquire that building. After 2025, I now said, year of assessment 2025. Year of assessment 2025. I now said, let me sell the building. This building that I acquired in 2024, let me sell it. I now sell it. Sales proceed. I sell the building for 17 million naira. 17 million naira. That is what I sell the building. If I want to compute the capital gain tax now, the cost of acquisition on this building is going to be what? 12 million naira that I bought it. This building, cost of acquisition will be 12 million naira. Abi? Do we understand?
Yes, sir.
Now, my capital gain,
Please, I don't understand this last one, sir, please. 12 million
I will
naira
explain
loss.
again. I will start from the beginning. Again, let me finish the computation. I will start from, this is my capital gain, 5 million naira. Do you understand?
Yes,
Before
sir.
I can compute capital gain tax on it, I will not say, less capital what? Loss.
Loss.
That capital loss that I make, less capital loss of how much?
2 million.
2 million. So the balance will now be net capital gain. which is
3 million.
3 million. My CGT, capital gain tax, at 10%
10%.
will be what?
300.
3 million times what?
300. 3 million.
Times 10%, which is what?
100,000.
300,000. Do we understand?
Yes, sir.
So let me explain again. In year 2023, I sold a building. The building, I sold it 13 million naira. And when I purchased the building, I bought it 15 million naira. I make a loss of how much? 2 million naira. That is called capital loss. The law says this capital loss, I can carry it forward for relief for the same asset, for the same building, for the maximum of 5 years. Do we understand? In year 2024, I now buy another building. Part of the 13 million that I received, I now use it to buy another building. That building costs how much? 12 million naira. In year of assessment 2025, that building that I bought 12 million naira, I now sell it 17 million naira. I will minus the price that I bought it. I will get what? Capital gain. I will not say, initially I have a loss from the old building. That loss of 2 million naira, I will minus it to get what? Net capital gain. Do we understand? After I get my net capital gain, I will now compute capital gain tax of 10%. Do we understand? That is how we arrive at that. Is there any issue on that again?
Okay, sir. So what is whether a loss is made or a gain, you have to file once you make sales. That's once you sell the asset, you have to file whether it is profit or loss.
Yes, you have to file. Because if you make a loss, if you don't file, you will not be able to relieve the loss by the time you make a gain. If you make a loss on building, you can relieve it again, gain from building. No, you cannot relieve a loss on building on a gain on plant and machinery. Same class of assets. Do we understand?
We do understand, sir. We do understand. I understand, sir. But is there any relationship between company income tax, or what's the relationship between company income tax and capital gain tax?
Capital gain tax apply to an asset. Company income tax apply to profits.
Okay. Okay.
Do we understand?
So please, so, what if in a situation where, sorry, please. If you, in a situation where you sold two different assets, you fight differently.
You sold the two different assets.
Yes, sir.
And you compute the capital gain tax differently.
Okay, no, wow.
Do you understand? When you sold land and building in a year, you sell plant and machinery in a year, you compute capital gain tax on land and building separate. Capital gain tax on plant and machinery separate. Do we understand?
Sorry, can I come in?
I have a question, please.
Okay.
Okay, so it's only when you purchase another, that same kind of asset, that you can claim the capital loss made on the previous assets. Is it what you're trying to say?
Yes, madam.
So if you don't purchase another kind of asset, you can't claim capital loss.
You cannot claim capital loss.
Okay.
Yeah.
So I have a question.
Okay.
During the calculation of this capital gain, you've been using the cost of the assets, right? So my question is, what if we are dealing with assets that depreciate? Do we still use the cost of the asset to less from the sales proceed or the residual value of the asset?
In capital gain tax, we don't know anything like depreciation. The question is, what is the cost that you buy the asset when you buy it? You know, capital gain tax apply to an asset that appreciates. Do you understand? It
Only
appreciates.
assets that appreciate.
Yes. Why? Take for instance, I buy a building 5 years ago. I bought the building 15 million naira. When I now want to sell the building, I now sell it 21 million naira. Is the building not appreciate? It appreciates. That is the reason why we are collecting capital gain tax. Because of those assets that appreciate, that you make, when you buy it, after using it, you even sell it more than the price that you buy it, despite that you have used it for some number of years. So depreciation does not applicable to capital gain tax. That is the simple answer. Do we understand? Do we understand?
Yes, sir.
Okay.
No, sir. No, sir. Sir, please. Sorry. When you were mentioning assets that are taxable, right?
Yes.
You mentioned something like plant and machineries. I know machineries depreciate. So are you saying, like, because you also said now that capital gain tax is only applicable on assets that appreciate.
Yes. Ladies and madam, you have a plant and machinery.
Okay.
You bought a plant and machinery. When you bought it 3 million naira. When you are now selling it, you sell it 6 million naira. You sell it 5 million naira. So, difference between the price that you sell it and the price that you bought it is the capital gain. There are some plant and machinery that have gain. Do you understand? Depreciation applied to company income tax. All this your company income tax. In this capital gain tax, we are saying that what is the original purchase price and this price that you later sell it. If the price that you later sell it is more than the original purchase price, it means there is a capital what? Gain.
Okay, Mr. Edus, let me come in there.
Yes.
Yeah, thanks for asking that question. When you look at what is happening recently in Nigeria, for example, you know that we have had loss in value of our currency, right? Now, imagine a car that you bought some years ago, like you bought a car for 1 million naira or 2 million naira some years ago. Now, if you want to sell the assets now, that car that you bought, you know, you were referring to plant and machinery, for example. So if you want to sell that car that you bought 5 years ago now, I can assure you the value that you're going to sell it now is more than what you bought it 5 years ago in Naira 10, isn't it? So, and that is why you see that even the Tokumbo Nigerian used car now, the amount that people bought it is not what they are selling it. They are even selling it higher than what they bought it for. So that means there is a capital gains that has arisen because of that. Do you understand me?
Yeah.
Okay,
so
thank you, sir.
because the capital gains tax has now arisen because of
Yeah.
the fact that the price that you are now selling it now is higher than what you bought it for. Ordinarily, the asset has depreciated, but you still make gain on the asset because it is now commanding much value than what you bought it for. Therefore, capital gains has arisen, and you are going to charge capital gains tax on the assets. Thank you.
Okay, thank you, sir. Mr. Chris. Yes, sir. So that is that. Do we understand now?
Yes,
so,
sir.
Okay. So let's go to rollover relief. Rollover relief.
So I think this class was meant to end by 10.
It's meant to end by
Yes.
10?
Then we have another class in 30 minutes then.
Mr. Chris.
You can briefly explain the rollover relief so that when you come back in the next class.
Okay. By next week, when I come back.
So you can take additional 15 minutes.
Okay. So the rollover relief is a relief granted when assets of a particular class are disposed and the sales proceeds from such disposal are reinvested in acquisition of new assets of the same class. Let me explain this. Rollover relief applies when you dispose an asset and there's a capital gain
Hello, bro.
on the asset. Yes.
Are you all right? Good morning.
Good morning.
I will send me a desk number. Okay, I want me to do something for him.
Please.
Diploma guy. You never come.
Please
And
mute
secondly,
your,
this is how far
mute
we
your
dey
audio.
involve.
Mute your audio.
The painting.
So rollover relief
You never come.
apply when you reinvest the
And I'm not supposed
sales
to be. I'm not
proceeds.
supposed to come. You know, say now today I get upper class. But since you know I need come there around small before you come.
Sir, can't you mute him, I beg?
So,
Okay.
Mr. Idris, mute everybody. You are the host.
Okay.
Kenneth
Okay.
there the work. Which one we dey again? You need labor to pen the thing. The pens dey for where?
Fidelis, you are disturbing the class now.
I want to mute him. Okay. So rollover relief is granted when the amount that you receive from the sales proceeds of an old asset is reinvested in acquisition of new assets. You understand? The summary part of rollover relief means deferment of capital gain tax payment. Deferment of what? Capital gain tax payment. Let me give an example. I said I sold a building. I bought a building and now sell it and make a capital gain. I now use the money to buy another building. That capital gain I make now, I will not pay capital gain tax on it because I have invested the building. I've invested the amount in purchase of what? New building. That is what rollover apply to. When you defer your capital gain tax to a future period, when you use the sales proceeds for sale of an old asset to reinvest in purchase of a new asset. In purchase of a new asset. But that asset must be the same class of assets. That is what rollover apply to. Take for instance, I bought a motor vehicle. I bought a motor vehicle or plant and machinery. So I sold the plant and machinery for a sum of 300,000 naira. Initially, I bought it 100,000 naira. I've made a capital gain of 200,000 naira. I'm supposed to pay a capital gain tax. But I now reinvest the amount of that 300,000 naira. I reinvest it, I use it to purchase another plant and machinery. So what that one means is that I will not pay capital gain tax immediately because I've reinvested the amount. I've used it to purchase another plant and machinery. I will pay capital gain tax when I now sold that new plant and machinery I bought. That is what rollover apply to. There are different types of rollover. What we need to understand, what are the classes of assets that are due for rollover? It's not all assets are due for rollover. There are some list of assets that rollover apply to them. Number one, land and building. That is another one. Fixed plant and machinery. Rollover apply to them. Ship. Rollover apply to them. Aircraft. Rollover apply to them. Goodwill. rollover applied to them. Stock and shares, rollover applied to them. Those are the classes of assets that rollover applied to them. Finance Act 2023 is the one that includes, before, we have class 4 of asset that is due for rollover. But Finance Act 2023 now increase it to class 5. You now add stock and shares. What that one means is that if you buy shares, now, you now sell it, you make a capital gain. You may not pay capital gain tax now. If you invest that amount of shares, that gain, that sales proceed, you reinvest it to purchase another shares, you will not pay capital gain. Now, how do we compute the rollover? What are the conditions for granting rollover? There are some conditions before you can be granted a rollover. Number one condition, the asset on which rollover is to be granted must fall in the class of asset from which rollover is available. What this number one condition is saying that for any asset that rollover relief want to be granted, they must belong to class 1 to what? 5. They must belong to class 1 to 5.
Fixed.
They must belong to what? Class 1 to 5. Do we understand?
Ship, aircraft, goodwill, stock.
They must belong to class 1 to 5. So that is number one condition.
Yes.
Number two condition is the proceeds from sale of the assets must be reinvested in acquisition of the assets, in acquisition of assets in the same class. What that one means is that I sell a building, 13 million naira. I must use that 13 million in purchase of another building if I want to claim rollover. If I don't want them to compute capital gain now, if I want to defer the capital gain, I must use that 13 million from that sale of building now, reinvest it in the purchase of a new building. Do we understand? Another one, the relief available. The relief is available, provided that the amount reinvested exceeds the original cost of acquiring the old assets. Ladies and gentlemen, we need to dwell more on this rollover because most of our question in the exam relating to capital gain tax, it will be based on what? Rollover. Most of our question in exam, most of the past questions, they are based on what? Rollover. So I will suggest that by next week, we dwell more on this rollover so that I've just do the brief introduction of it. You can read more on it, but by next week, we will talk about the type of rollover available. So, and we will give example of rollover. There are different types of rollover. We have full rollover, we have partial rollover, and we have nil rollover. So we dwell more on them, and we will do more illustration on rollover. We will do more illustration on rollover. Our next week class will base basically on how we can compute rollover, because in past question, capital gain tax is a must. As petroleum profit tax is so important, capital gain tax too is very important. And most of the questions that will be set on capital gain tax is on rollover. It's on rollover. So we need to pay more attention to rollover. So by next week, we will do more questions on rollover. So thank you very much. So we solve more questions on rollover by next week. Thank you very much. Yeah. So do we have any question, any observations? Any question, any observations? Do we have any question? So since we don't have, Amaka, do you want to ask a question?
No, sir. No, sir.
Okay. So since we don't have any question, so for you to prepare for the next class, we can call it a day. So our next class is still on capital gain, and it will be based on rollover. So thank you very much.
Thank you, sir.
Yeah.